Welcome back, folks, to the channel. Well, today we got some new data out. Pretty interesting. I want to talk about it a little bit. Powell said a couple things today. He kind of stepped back on his stance yesterday. He must have looked at his little iPhone at night and seen, wow, I'd sure dumped the S&P. I better dial back the rhetoric for whatever goddamn reason. So he came out today and reiterated his statement from yesterday, but said, hey, we haven't made that decision yet. That decision will come if the data should suggest that we go to 50 basis points. If we look over here, not there, but look at our little Fed watcher, we have jumped up another considerable amount from our 70%. We jumped another 9%. So we're about 80% certain right now that we are going to get that 50 basis point hike according to our Fed watch tool here. Very interesting. That just keeps going higher and higher. So not great. You would think this would mean the market would be coming down more, but we are absolutely in complete denial and delusion right now stage of the economic cycle, obviously. And that's all right. I'm not like fully short right now. I'm not just getting like shredded. I'm just patient. Have time on your contracts. But anyways, notable that this keeps going up. So this is basically telling us that we are going to consider to see bad data. And we got a little taste of that today. We got our ADP private payrolls rose by 242,000. We were expecting 205,000. So once again, another jobs number coming in red hot. Another example of our labor market just keeps getting tighter and tighter and tighter. And there is no end in sight. Why is that bad? Well, because inflation ain't going anywhere until we see that labor market settle down a little bit. I mean, it just hasn't at all. And there's no end in sight. And this leads me to wonder, what is the case for the Fed to pause rate hikes? Like, what is the case? Where is the pain? People are saying they have to pause because these rate hikes are getting too high. It's getting out of hand. But then I challenge them to be like, where is it getting out of hand? Where's the pain? The stock market has retraced 15%, but no one's lost their jobs. No one has stopped getting raises. No one, I mean, yes, there is pain. I mean, the middle class can hardly fucking afford a mortgage or to pay rent. But outside of that, that's not the Fed's fault. It is the Fed's fault. Thank you for COVID, all that trillions you printed. But that's my personal belief right now is like, where's the pain? Where is the reason for the Fed to cut rates? We know inflation hasn't fully come down. It's still well above their 2% target. We know that jobs aren't coming down. The unemployment rate is still at 57-year highs, or 57-year lows, I should say. So yet another reason to be bearish. Fundamentally, another reason for why. I mean, you go on CNBC and you hear these clowns who are like, the Fed doesn't need to do this. They shouldn't be doing this. They've been wrong. They shouldn't be doing this. And I'm just like, why? Why shouldn't they be jacking rates up? Nothing is broken. Nothing's even come close to breaking. The bond market is going crazy, but the real life economy hasn't changed. People are still spending. Prices on everything are still going up, and people are still paying those new higher prices, and they're still getting raises that are matching those price gains, which takes me to my next topic, JOLTS numbers. Once again, we got job openings dropped to 10.8, but they're still way too high for the Fed. This is still higher than expectations. So once again, another set of data for the labor market that is higher than expectations. Most of 22 was revised higher, so nice, well done. Just craziness. If we look at this chart here, you can see this is our job openings. So you can see it's just chopped around. We peaked back up here at 2021, and there has since just been like well over 10 million job openings. And then we look down here, number of jobs per unemployed worker. So we're still at 1.9%, 1.9 to 1. So there are 1.9 open jobs per one person looking for a job. So twice as many jobs nearly as there are people looking for a job. Crazy. Still, that is the tightness. That is when the J-Pow comes out and he talks about the labor market. That's the tightness he's referring to, is that there's still so many jobs. Everyone is still trying to hire people, but there's no one to take those jobs. Thus why wages keep increasing. Thus why inflation continues to stay elevated because there is just no reason for inflation to come down. What is going to cause inflation to come down at this point? It has to be people losing their jobs. It is not going to go anywhere. There's no reason for businesses, for companies, for everything, the price of everything to continue going up when people are still paying them. And then the longer this goes on, the more likely that inflation becomes entrenched. And what I mean by that is everyone is just like, yep, inflation's just going to be 5% for forever. That is exactly what happened back in the 80s. Except back in the 80s, or back 70s and 80s, the Fed, they kept flip-flopping. They go, hey, we're going to jack rates up. Oh, inflation came down. Let's slow down. Uh-oh, inflation's back up. We're going to jack rates up. Oh, no, it came down. They flip-flop, and it was just a 15-year period of absolute pain. The Fed is doing that once again. We have to ask ourselves, why would they go from 75 to 50 to 25 basis point hikes? Why have they slowed down their pace of rate hikes when there has been no pain in the labor market? There has been a very marginal drop in month-over-month CPI or year-over-year CPI and PCE. There's been no change in service inflation whatsoever. Housing prices, that's another big one. People are talking, oh, the housing market can't take the pain. Where's the pain? The housing prices aren't coming down. Sure, no one's buying, but the prices are still up there. Like, where's the pain? That's what I have to ask any of these people that are like, the Fed, they're getting too aggressive. And we know the Fed would rather err on the side of being too aggressive than being too dovish, because they have said, Powell has literally said this. He said, hey, if we over tighten, if we cause a rug pull, if we do the hard landing, we can immediately, boom, overnight stimulate the economy. Exactly what they did back in March of 2020, why the stock market was going straight up. You know, it's that like meme of the little girl on the swing going like la-di-da, and then in the background, the fucking house is on fire. That was the stock market in 2020, because the Fed, they run the game. They pumpeth and then they dumpeth. And that is exactly what they could do if the market does rug pull. So very interesting. So once again, we are going to just be 100% data. The market right now is 100% data driven. It has been for the past couple years. So we are getting our jobs numbers on Friday. If those come in hotter than expectations, I expect that will be negative for the market, because that is exactly what Powell has said. He has said we are going to wait for the data. So if he comes out and he just says it over and over, we need to see labor market tight or soften. We need to see that soften. And there's just been zero sign of that. And we're almost at 5% rates. It's just craziness. So if we just keep getting no sign of slowing down the labor market, if things just keep getting tighter and tighter and tighter and unemployment keeps going down, that will push the Fed to go 50 basis points. And then next week, Tuesday, big one. We got CPI coming out. Boom, we got CPI coming out. It's that time of month again. Once again, we're getting that CPI number, baby. Whew. I'm excited. It's going to be huge. If we get another CPI, another year over year. So January CPI year over year came out. We're at about 6.5%. And you could see what was happening. You could see why the market wasn't really rallying, but why we weren't just going straight down. You could see we were declining. Very nice. Exactly what you want to see. But here in January, you could see December, we came down, but they actually revised it upwards. So we had a month. We've had basically 2 months back to back now of higher than expected inflation. So what you're seeing right here is this plateauing. We're plateauing. That is not what the Fed wants to see. The Fed needs to see inflation going straight down. So if we get another month of February where, God forbid, we tick up, we go up to like 6.6% year over year, even if we stay at like 6.4% year over year, that will be 3 consecutive months of us sitting at 6.4% year over year core CPI, or just headline CPI, which if you take it down to core, that's at about 5%. That will be a nightmare scenario. We will have plateaued at that number, which is terrible. You don't want to plateau at 6%. We're trying to get it at 2%. So that's 3 times more than we're trying to get. And the thought is that you need to match interest rates with the rate of inflation to bring them down, to bring one or the other down, basically. So it's a tug of war. You got interest rates on one side, inflation on the other. But if we get our interest rates to 6% and then inflation just stays at 6%, that is very, very bad. That is where you get expectations unanchored. When inflation expectations become unanchored, then inflation just gets out of control. You get a repeat of the 70s and 80s. That's exactly what happened. Google it. You can look it up for yourself. So not good. And that, I think, is why you saw today the stock market really didn't do a whole lot. We were basically sideways. I mean, you zoom in on this 15-minute. I mean, this is nightmare price action. What are these wicks? Look at wick. Just disgusting. So we did make a bit of a lower low on the S&P. We did go down here to 396.62. Nasdaq is holding up stronger, which is super interesting to me because the market is now very certain that we're going to get 50 basis point hike. So we are very obviously in the denial area. We are still holding on to this dream that the Fed will pivot at some point this year. So 100% market's right now in the denial zone. That's just absolutely true because fundamentally everything is pointing downwards, but the market's still somehow going green. So it's day to day. You don't know what's going to happen to the stock market. It doesn't really matter. It's unpegged from reality, but it's over the long term where the fundamentals start to matter. So anyways, next up, we got that CPI. And now we have to ask ourselves, where is the Fed going to stop? Are they going to stop at 6%? What if we get to 6% and then CPI doesn't move still? Do we have to go to 7%? What if we get 7% and the labor market hasn't moved either? This is, I think, the reality, and the market is just ignoring that reality right now, clearly, because we are just somehow not going down. But it really is just eating away that dream. I mean, we went straight up in January because the market was just dreaming. We had a dream. We went up 10.5% in January on the Nasdaq on the dream that the Fed, they will someday soon cut rates. They will pivot and all will be well. Inflation will be beat. That dream is just falling apart day by day by day. With more data that comes out, we are still seeing the job market hasn't moved. We are still seeing inflation is still unpegged. It's unanchored. It is completely just, there's just no reason for anything to come. I mean, it's really just crazy. I feel like this is just so obvious, but the stock market just, it goes on its own version of reality, and that's completely fine. And it always has and always will. But we can also look at our wage growth. That was very interesting. So wage growth decelerated slightly with those remaining in their jobs, seeing a 7.2% annual increase, down 0.1% year ago. So if you stayed at your job, you stay at your job, you made a 7.2% annual increase. There's inflation. There is the wage price spiral. Now, things were looking terrible back at this time last year. If we look at what the S&P did this time last year. I mean, March was a green month, but God, April was one of the worst months of last year because Ukraine war, everything was uncertain. So now the market has recovered on, things don't seem as uncertain, but I would challenge to say if things are still more uncertain than ever. Sure, the supply chain has been fixed, but that was a lot of what we were blaming inflation on. A lot of people were like, it's oil prices. It was supply chain. It was this. It was that. All of those things have been fixed. Gas prices have come down. The supply chain has recovered. Now we are getting that real, this ain't just those things. This is inflation on a whole nother level. So are we going to see a repeat? Are we just going to get a repeat of April? I mean, March was just euphoric. Wow, look at us. We're going straight up. April was just a nightmare. We just shit the bed all of April, all of May, all of June. Nightmare month for the stock market, or nightmare quarter, I should say. Is that going to happen again? I don't know. But we are starting to be faced with that reality that we are seeing a wage price spiral where wages go up 7%. So why wouldn't inflation just go up 7%? If people are getting 7% more at their job, they're willing to buy something that costs 7% more than it did a year ago. So these people, you're not getting real raises on your wages because they are just all getting eaten by inflation. It sucks. So now that I've gotten all that out of my system, we've talked about the fundamentals. Let's look at the charts a little bit. So right now, S&P kind of sideways, just an ugly consolidation day. We're definitely waiting for Friday. I don't think we will get a crazy move. I'm kind of expecting a little bit of upside from this point. Not going to lie. I'm not going to lie. I would expect the S&P, we could come up and retest this trend line up here at about 405. I'm actually kind of banking on that. I would very strongly see that be a reality. Because I think we are going to be a little bit elevated once we get that CPI number. And I'm not going to say guarantee, but CPI is probably going to rug pull us because we got our ISM manufacturing data that told us prices have already gone up. We know that prices are still elevated, that they're still going up. This was not just a one-off. This has been since the end of last month. We have seen a revised December CPI that was revised to the upside. We had a red hot January, the highest since October CPI report. And now we are expecting probably the same in February. Not expecting. It could be higher than expectations. Then that, yeah, we're rug pulling. We're seeing like 4% drop because that will guarantee that the Fed isn't even close to being inflation. So really, I would honestly be very, very cautious going into CPI day. If you're swinging anything short term over Friday or over Tuesday, you are 100% just gambling. So good luck if that's what you're going to do. I'm personally not going to do such a thing, but we could be range bound. So below 396, this is pretty clear. We have support at this level right here at 397. Below 397, 396, looks like we want more downside. I would not think we are going to go to 410 unless we can break above this trend line right here and then break above this supply zone. Got to break above that. We do have a gap, but you can see the key level right here. It's very important at 408. So break above 408, break above that trend line. Things look much more bullish, even despite the fundamental data that we are getting. And then we have a massive supply zone up there from like 412 all the way up. I mean, just so many sellers. This is always where sellers stepped up. So lots of levels to take out. But to the downside, yep, below 390, below like 397, you know. Doesn't look great. Doesn't look great. So let's look at the Nasdaq right quick. Nasdaq, we're bouncing off this trend line. We also have another trend line up here. This is our trend line that we respected perfectly over here. If you look at this, I mean, just boom, boom, boom. Perfect rejection off that trend line. So break of that, I'm thinking upside looks good on the Nasdaq. Huge supply zone right here at 304 where we tapped right there. I mean, that confluence was just crazy. If anyone caught puts off of that, that was huge. Congrats. But to the downside, look at that. We're right back in that zone. I told you guys about this zone. I was like, hey, we got to get it back above 298. And look at right where we're rejecting. Right off 298. So above 298, we could see a push up to this trend line. I really think we're just going to be range bound going into CPI. I kind of guarantee it. I would not imagine the market is going to make a big move. Because if you look at the volume on the day, I mean, ugly volume, low volume. If you look at the volume in the S&P, low volume with a doji. I mean, just super uncertain right now. So looking at Tesla. Now Tesla, my Esla, what did I tell y'all? Didn't I tell y'all that's about this head and shoulders here? Man, look at that head and shoulders playing out perfectly. So right now, we break this level at 180. We close below that, and Tesla looks fantastic to the downside. So we have gaps to the downside. We got multiple gaps to the downside on Tesla. I would very much expect a bounce off of this supply zone. Right there. Bounce off that supply zone. A little bounce to the upside. Maybe retest 180. You know, let's draw this out. I like doing a little bit of this here. I like visualizing it a little bit. We pull down. We bounce off that. Retest that. And then we eventually see ourselves heading below that. That is very much what I can see Tesla doing. And then we have big gap down there. So monster gap to fill all the way down to 146 from 154. What do you think the odds are we don't fill that gap before Tesla bottoms? I mean, really, come on. Seriously, it looks a little too free, a little too easy. I just know everyone sees that gap. So the market makers are going to do they're going to do some crazy shit on that gap. So be careful. But Tesla looks fantastic to the downside. We have to talk about NVIDIA. NVIDIA is just killing me, man. NVIDIA is completely... semiconductors are completely unpegged from reality. They do not care about anything. They only go up, and that is just the way it is. But I certainly cannot fathom buying NVIDIA at $242. It is beyond crazy. And now look at this. We are back to where we were last March. This is crazy, man. Let's look at where we were March 8th of last year. We were at like 206. And then over here, March 17th, we're at 240 on NVIDIA. I mean, we were literally right back to where we were March of last year on NVIDIA. Just completely insane. We are super obviously in this rising. I mean, this really looks like a rising wedge right now, honestly. So NVIDIA to break at, I mean, the highest I could possibly see NVIDIA going right now is to tap the top of this ascending, which my face is covering, tap the top of this ascending wedge up here at 250, which would be a kind of tapping this gap at 253. So maybe it just wants to fill this gap all the way at 258. I could see that being a possibility too. Why not, honestly? NVIDIA is just cracked out of its mind right now. There's no shorting it. I personally am shorting it June puts, but it's a very small position. I'm willing to add on to that if NVIDIA does show signs of weakness. But right now, I don't think that's going to happen until we get that shitty CPI report. I think that will be the eventual push to the downside that the market is going to need. Right now, it is just completely just clinging to the dream. And I think that dream is destroyed come CPI day. So NVIDIA still looks good to the downside, but just not going there. Apple, man, what an ugly day for Apple. Huge daily inside bar doji on Apple on non-existent, super low volume. So inside bar, it's kind of, it kind of tells you that there's a lot of indecision. It doesn't want to go up. It doesn't want to go down. And then the doji on top of that, man, just Apple does some textbook things. But to me, I like Apple to the downside still. Once again, wait until Tuesday. Wait until we get that direction. Because right now, it feels like the market wants to squeeze as many shorts out of it as possible until it eventually does dump off. So that's what I'm thinking on Apple. I'm not shorting it yet, but personally, it looks good to the downside. Better risk to reward than to the upside, in my opinion. Microsoft, I mean, once again, we ripped down to this zone where Microsoft has bounced before. So wick to the downside on non-existent volume, dude. Look at the volume on Microsoft today. This is the lowest since the day after Christmas on Microsoft. What the hell? So this is super just, I mean, everywhere I look, it is just indecision, indecision, indecision. And I just don't know how we are going to go from completely indecisive to, hey, we should continue to rally when things just day by day get worse and worse and worse. I really don't understand how it could possibly happen. I wouldn't be surprised if it does. The fact that I'm saying this probably means we're going to go up. But all jokes aside, this is not financial advice. This is for entertainment purposes only. And if you've watched the entire video, I really appreciate it. And I'd also ask that you consider hitting the subscribe button, hitting the bell for notifications for daily uploads. I do these for free. I don't have any paid Discord or nothing. I'm just doing this for fun, for educational purposes. And consider dropping a like if you enjoyed it. And drop a comment too if you hate my commentary, if you hate my face, if you don't agree with anything I said. I appreciate all comments. So I will see you guys on the next one. Take it easy. Peace.